Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce. As always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We have a returning favourite here at Equity Mates. We know him from the Pimp My Portfolio segment.
Yes.
But today, Bryce and I get the chance to pimp his portfolio, to go under the hood and see what he's buying and selling. Luke Laretive, welcome back to Equity Mates.
G'day, boys. How are we?
Very well, very well. So, yeah, a bit different. No pimping portfolios today.
No ETFs today, boys. No ETFs today. We're getting down and dirty.
I think the thing with Luke is that you are an advisor, but I think in your bones you're a portfolio manager.
Yeah, I mean, my job is you start out as an advisor, I suppose, ringing, 50, 60, 70 family groups, telling buy this, sell that, buy this, sell that. And then you quickly realise that your ideal ASX 300 portfolio or your ideal small cap portfolio, every client should just own that. Why would how am I going to get 70 family groups at various dollar prices in and out of a small cap company reasonably, fairly, equitably across my entire client base? Who do I ring first? Who do I ring last? It's just a practical problem. So, you kind of get to a scale where you're an advisor, and if you're any good and you've actually got good IP and you want to be able to distribute that broadly and widely, you kind of have to become a fund manager.
So in this interview, we want to interview Luke Laretive, the fund manager, rather than Luke Laretive, the financial advisor.
Yeah.
So we're going to talk about your investment philosophy. We're going to talk about, you've actually just closed the first anniversary of your small caps fund.
It's not closed, but we're still going.
You celebrated,
I wish it was closed.
Celebrated the first anniversary. So we're going to talk about some of the big learnings you've had over the past year. Then we're going to talk about a few stocks that you're looking at now, including a recent mining trip to WA that you sent a bunch of DD back to Bryce and I that we want to share with the Equity Mates community.
Now, if you'd like to get in touch with Luke, we have a form at equitymates.com/advice where you can. You are the founder and portfolio manager at Seneca Financial Solutions. We should make that clear. But Luke, let's crack into your investing philosophy. How would you describe it?
I think investing's pretty simple, right? You got to know what you know. You got to know what the market or what everyone else knows or probably knows. And then you've got to figure out if there's any difference between those two things, and then figure out, do you know how to exploit that difference or the best way to exploit that difference? That's it. There's no need to be philosophical about investing. It's, you want to buy a share for $1 and you want to sell it for $2. It's that, it's not complicated. I think, people get a bit high and mighty. Oh, I'm a growth. I'm a make money investor. That's the, that's the type of investing you want to do. Is you want to be a make money investor. And if you need to be, finding value ideas in some sort of structured asset play, then you should be able to do that. And if you need to identify underappreciated and, undervalued growth in a business that people have discarded for whatever reason, then you should need to be able to do that too. And you need to be able to identify inflecting profitability. And if you can't do mining, then tough titties, but you should be able to do that too. To me, I think we like to create these marketing narratives for people to make it easier. But it's all just fugazi at the end of the day. What matters is, can you do it? And that's kind of how we invest. So pretty simple. We try and find things where the market's embedded an idea, a concept, a narrative, a story that isn't supported by the evidence. It's not supported by the data. Or probably more accurately, where the market is ascribing a probability to something or probability, based on the pricing, a probability to something that we think's not quite right. So it really does come down to being that simple, and almost every idea we're going to talk about today and the way that Benny and I talk about stocks every day is kind of in that sort of lens.
Now, you say it's simple, and when you describe it like that, it is simple, but each of those elements have a level of complexity behind it.
Of course.
Knowing what you know, but then building conviction that you're actually right is difficult, and that's where a lot of investors fall down because they think they know something and they're wrong.
Correct.
And then the second part is knowing what the market knows.
And what's in the price.
Yeah, that is hard as well. Let's hold on the second one. Like, how do you figure out what the market knows?
So we use investment bank and broker research as our proxy for what everybody else knows. So, if you're a stockbroking client at any firm anywhere in the country and you get a note from your analyst at the firm who says, this stock's a buy and it's got a price target of whatever, we get all of those notes from everybody every day and we read them and we figure out, okay, these are the 7 analysts covering this stock. Here's all their estimates for every line item in the, forecast. And here's their thesis they've written out on, why they think this is a buy, hold, sell and how they've come to their valuation conclusions and what they think the catalysts are. And what they think that is going to happen at those catalysts for the stock. And then we try and figure out, do we know something else?
Doesn't that become harder and harder, though, as you get into the smaller end of the market?
Well, the best thing about the smaller end of the market is there is no brokers. There is no analysts.
Exactly.
So how are you
then,
assessing what the
proxy?
market thinks?
So we generally just go by, what's the narrative for this business? And an easy way to do that, I suppose, is what's the story that management tell? What's the story that this management team is out there promoting? If you're talking about a company that's $100 to $1 billion market cap, that's going to have broker coverage of some description. It's going to be house broker coverage in the sense of it's the company that's getting paid through capital raising to that business to promote it. So they're going out there with the most positive version of the truth. Whereas I think, our job's probably in that instance to not be, caught up in the conflicts of interest that exist in that environment, and, try and be objective and kind of discern what we think the actual truth looks like relative to the sort of the spin that you're getting sold often. In short, that's how we do it. But developing that feeling, vibe, understanding, reading stuff quickly kind of figuring it out is probably just also a bit of experience. One of the advantages, I suppose, of our business is Ben and I and even the people, the admin staff and, John, my business partner, like we're all practitioners. We've all been doing this stuff for a long time. I've lost plenty of money sniffing around in small cap companies over the years. I think a lot of the institutionalized small cap fund managers aren't actual practitioners. They're like professionals. And I know that's kind of, I probably should not describe myself as a professional, but I would say I'm more of a practitioner and less of a professional. And I think there's too many sort of academic investors out there and not enough like dirty street urchins like me, and I think that's actual an edge because you look at things through like this entrepreneurial kind of like hustler lens and you just see shit differently. Like a guy who, if you're talking about a cafe, if you're McDonald's opening a cafe or you're like local independent person opening a cafe, you think about that particular shop, that particular location through completely different lenses. And that's kind of how, big international fund manager running an ASX small cap company, small cap fund, looks at companies versus how maybe we would look at companies.
It reminds me there's this investment banking memo that goes around every now and then from Bear Stearns. It does the rounds on social media, and the MD at the time basically said, "Stop! We're not going to hire people from good institutions. We want people PSD, poor, smart, and a deep desire to get rich."
That is literally how we hire at Seneca. It's the same sort of mentality.
Yeah,
Hustlers. Yeah.
Bear Stearns actually no longer around, so take that for what you will.
Probably also what's going to happen to Seneca if I'm not careful, but we'll talk about that later. Yeah, no, I'm joking.
But Luke, I think over this year on Equity Mates, you've built a reputation for calling it how it is.
Insulting your listeners, yes, I'm aware.
And for people that know you from before Equity Mates, that certainly isn't a new character trait. You like calling bullshit where you see it. So we want to get your view on the funds management industry and the industry more generally, because there's a lot of conventional wisdom. There's a lot of stuff that you probably think is not quite right. So this is your chance. Get on the soapbox. What do you think is bullshit?
This is a bit of a where do you start?
What's the conventional wisdom that we should disregard as investors? Like where are we getting steered wrong, I reckon is the question.
I'm talking my own book here, right? So this is my opinion. It's not even probably a Seneca opinion. We probably have different opinions inside the business. So let's just call it for what it is. This is Luke, not Seneca talking, right? Or anyone else talking for that matter. And I'm probably wrong. So, take it for what it is. In my opinion, the concept of being bigger is better, more is better access, 20 analysts is better than 2. I just don't agree with that. I don't think that having a team of specialist investment analysts all researching individual sectors and specializing in stuff and then coming together and trying to make consensus portfolio decisions and, managed by some PM whose job is primarily to do BD and be a good-looking mouthpiece to come on Equity Mates and talk about why they should raise money, and reporting to some offshore shareholder base managed by some guy in New York. Like, to me, that's not how you manage money. Like, if I look at all the good business owners, I mean, you guys had Twiggy Forrest on recently, right? Like, he's dirty street urchin level, especially back in the day, right? Like, he's real dirty street urchin. But, you know, when you've got complete control of your business, you are just balls to the wall in it. To me, that's where you find the best practitioners. That's where you find the best success. That's where you find, you know, what you guys are doing here. Like, you just balls to the wall, all in. This is what you do. You know, whether it's, like, I caught up with Aorus yesterday, Stephen Arnold. Another perfect example of someone who was just balls to the wall doing what he's doing, right? We always talk about Fairlight. You guys love Nick, you know.
Yeah.
Exhibit B, like, you know, you can come to me, it's same sort of shit. Like, it is that idea of, you know, 20 analysts, do you make better decisions? I'd argue no. We've always sort of had this, like, my dad was in the army, so I sort of always think about this, but we had this sort of SAS mentality, like, you know, 5 elite people are better than 50 average ones. You can apply that to a lot of financial services industry. And I think a lot of people, particularly older people, retirees, they feel like, oh, if I go to a big brand, if I go to a well-known, I can't go wrong. Well, the reality is everyone who's good at has left and wants 100% equity of boutique XYZ, and they're over there and you've never heard of them, but they're way better because they left where they were and went somewhere where they had 100% of the pie. Because who would want to be there if you were good? Because you can make a lot more money on your own being out. So I think that, you know, all the best advisors I know, all the best fund managers I know, they all work in boutiques. There is not a single good fund manager that I know that works at Investment Bank XYZ. I could slag someone off here, but I'm not going to do it.
Name some.
You know, like I could easily do it, but I'm not. I'm not here to ruin people's lives. But the point is that, except yours, you two. That's my, you know. Nice. So, you know, I would rather be at a boutique. I'd rather be investing with boutiques as a general comment. We use institutional money, and particularly, like, you know, global bond markets. There are places where scale does matter, but if we're talking about equities, and, you know, my wheelhouse, you know, Australian equities, I'd argue that we're a niche market, and the best businesses and best practitioners are kind of niche.
So, with that in mind, you have just celebrated your first anniversary running your fund, the small cap, the Australian Small Cap Companies Fund, returning 28.4%.
Big year.
Big year.
What did the index do?
10 less.
Nice.
So,
9.6 less, yeah.
Nice.
Great outperformance, but there are 4 key lessons that you have identified across the last 12 months. I'll go through them now, and then perhaps let's work through each of them, and if you can bring them to life with some examples of what's in your portfolio. The first one is unloved cyclical recoveries can make great investments. Second is just because you spot value today doesn't mean everyone will agree with you tomorrow. The third is there are no shortcuts. You must do the work. And the fourth is your network matters. So let's start with the first. Unloved cyclical recoveries can make great investments. What's the learning, and then how does that come to life in the portfolio?
This is where a cyclical is a business which has some sort of like leverage to the business cycle. Their earnings follow the business cycle or a cycle to a degree. Commodities are the super leveraged version of that. And if you're a oil and gas tugboat operator like Mermaid Marine, which is called MRM, it's been taken over now, so it's probably not.
Mermaid Marine.
Right. Nice. It's not called, it's called MMA. It was called Mermaid Marine. It's now called MMA Offshore before it got bought. But essentially this business went from $20 to 20 cents. So nobody wanted to own this thing. It had torched every fund manager in the country, every institution in the country, every super fund in the country.
And then they called you.
Yeah, right? Literally. Yeah. And then the urchin cropped up, right? So you know, it had been absolutely torched. And even I'd never owned it, but I was a bit gun shy about it. And this is probably a good example of, like, you know, you can have an educated conversation over the desk, and I was like, oh, I'm wrong here. Like, Ben's right about this. Like, so Ben was like, this business has turned. Like, these guys' earnings is kicking back up. So these tugboats that tow around stuff in the ocean for oil and gas drillers, they actually take a long time to build. So the lead times are really long. But the oil and gas market can turn quite quickly. And what happened is the market conditions actually turned. Drilling activity was going up. And there was no boats available, and people had 8-year order books for boats. And so bigger companies were just, the easiest thing to do was just to go and acquire a company who had good assets. And so this business earnings were going up, you know, making more money, better utilization, all the stuff you'd expect to see. And everyone just ignored it because Why? Well, they'd been torched for 6 years prior. So we kind of identified it. Probably could have got it earlier if we started the fund a bit earlier. We knew about it, but and we knew it was going to be like one of the inception positions in our fund. It was going to be a big position in our fund, but we didn't, get the fund up until October. So, 1st October. So yeah, we bought that really cheaply and made, over 100% of our money inside 6 months pretty much on a takeover by Sign Renewables. The lesson here, I suppose, is just because what has happened might not continue to happen, just what everyone else says or believes or tells you is the story, isn't necessarily the story. And ironically, it's normally in those instances that you can find exceptional risk-adjusted return and an exceptional, I suppose, margin of safety. Like when you find an idea like that, you can go balls to the wall. You can put it in your portfolio at 8%. And that's how you make good returns, is because you find something that's you've got such a margin of safety on it where you almost can't lose. Right now in the portfolio, we've got, stocks like Catapult in our portfolio, PointsBet, RPM Global. Like these stocks are ripping right now, right? Absolutely ripping. And we've owned them for over a year. Why? Because we've got them in huge weights in the portfolio because there's margin of safety there. Like we understand the business, we build that conviction, we do the work. I'm kind of going to get to doing the work in a minute, and you can see these things. So yeah, you got to understand where things are in the cycle and how you can maybe leverage them, and then how much margin of safety you've got in doing that at the current prices.
Second lesson: just because you spot value today doesn't mean everyone will agree with you tomorrow.
Like GQG is another stock. We owned a lot more of it before. We actually own a bit less of it now. They listed at $2 a share. And we'd been investing with GQG in our global product for a while, so I kind of knew the funds, I knew the managers, I knew what they were doing in terms of BD, who they'd hired in Australia, and I was like, they're good little BDMs. They'll be able to sell to other advisors. They'll be able to get good inflows. And what are you smiling at?
Well, does GQG with almost 200 employees count as a boutique, or does it count as a 20 analyst consensus?
How is GQG owned?
I imagine by the employees.
It's owned pretty much by one guy. It's like there's such little free float of stock out there. It almost is like a macro boutique the way they operate, right?
Okay.
So it's a
stretching the definition.
Well, you can be bigger, but still act small, like what that's a stupid saying. They say, think global, act local, or whatever. There's some. I'm sure that's written on some coaster somewhere, but you get my gist, right? But look, GQG they're really good at what they do, and they've had great numbers. And because of the sort of Magellan saga with Hamish Douglas and what was happening at Platinum and all this sort of stuff that was going on in Australian funds management, it just got derated with every other large cap active manager in Australia on the simple basis that they all had outflows and were losing clients. But GQG was doing sick inflows every month. And for 6 months, I was just like, what is wrong with everybody? Are you guys not reading anything? Is no one paying attention here? So we just kept buying stock, $1.30, $1.40, just bought heaps of stock. And I was like, look, margin of safety again, worst case scenario, this thing pays out 80% of its earnings in dividends. I'm going to get and I don't understand how funds management business works, very high margin business once you've got the overheads and stuff covered. So I was like, well, I'm going to get 8.5% dividend yield here, worst case scenario. It was at the time a small cap bear market. I was like, well, if I'm at 8% on my biggest holding in the portfolio, well, that'll get me halfway there in this bear market. I'll probably still beat the index just on that position alone. So, I was like, okay, worst case scenario, we get paid a div. We're in a business that we understand, and the markets will turn at some point, and this business will have more leverage to markets, as they all will. Okay, cute. But eventually the market figured it out. GQG's fund under management every month were just going up and up and up and up, and everyone else's were just going down and down and down. And it's still cheap. It still only trades on 15 times earnings. So this business earnings just ripped. Dividends have ripped. Sure enough, share prices now, I don't know, 250, 260. It was $3 a share. It was over $3 a share just recently. So it's got good leverage to markets. It's still not expensive. You get paid a really good dividend yield to own it. And for us, we have sold a little bit, and that's just to fund other things. And as things get higher in prices, your potential for outperformance falls. It's just a function of price. So
that's interesting, because when I read this lesson, I thought you were going to say you found a great investment that was valuable, but the market never realized the value. But no, what you're actually saying is it realized the value 6 months later.
Yeah, so you had 6 months to sit around with the data that was available. I'm talking, this is public ASX announcements. You don't have to do you don't need to know a broker. You don't need to have access to anybody. You don't need to meet a management team. You can just read. This was just read the announcements, and blind Freddie could see this, right? And not a single fund manager was out there buying it. Nobody was talking about it. You can go back and look. Like, the best thing about, doing all this content is we're on record. Go for your life. Like, it's all there, So I just, it was one of the ones, it boggled my brain. I had clients bitching to me. I'd bought stock at, $1.60, $1.70, all the way down, $1.40, and bought all the way back up again. And I had clients being like, when's this thing going? It's going nowhere, market's moving. And I was like, oh, it'll be fine. Like, it's still too cheap. Can't sell it. Just got to hold it. Like, it's too cheap. And sure enough.
Did you give a bit of them told you so?
Mate, you're talking about...
Did he give him? Of course he did.
Are we mates? Like, do you know me?
I don't know if you have to speak to your clients
They're probably
differently.
not clients anymore.
I speak to my clients worse than I speak to you two.
So that's the second lesson. Third lesson, there are no shortcuts. You must do the work. Shouldn't this say Benny must do the work?
That should say Benny must do the work.
For context, Benny is Luke's analyst.
So look, no, Ben does do a lot of the work. Well, we just do different work these days. It's probably the right way to put it. But he is a very good analyst, Ben. He's a very smart young man. And I'm really enjoying doing these products with him and working together. It's made my life heaps more enjoyable at work having him. And we're doing some unique stuff as a result. But look, I think when we say you got to do the work, you can identify value. So I'll give you this example is actually quite neat. So Global Data Center Group, I think I might have spoke about this on the thing before. Like, a lot of people, there's a lot of fund managers, people out there in Twitter, people or whatever, talking about, they had this 1% stake in AirTrunk and the shares were worth less than probably what the 1% stake in AirTrunk, and they had these other 3 businesses that they were going to do. People knew that probably for 2, maybe 3 years. And that's cute. You can know value exists, but one of the key things that we focus on a lot is, okay, I can find value. What's going to change? And that's like, but you got to be patient. Like I said about GQG, sometimes you can identify the catalyst, but you don't know when, you don't know when. I think this stock was like, well, at one point 14 months ago, there was an AGM, or I can't remember, I think it was an AGM. Management put in a bunch of new share-based incentives around share price realization and transacting on assets. So if you weren't paying attention to the appendixes of the AGM and the management remuneration, which I'll give you anyone a hot tip. If you want to go and find what's going to happen to your shares, just go and look at the remuneration page of your management incentive. That's what's going to happen. People do get their KPIs. That's what they do because they want their shares. So I think Ben picked that up. We realised where the tranches were going to go. We did the math, figured out that management were going to make millions of dollars if they made us millions of dollars. So again, we could build huge conviction in a position. We could take a big bet on something with a margin of safety, and that share price oscillated. If you look back, there was different little drawdowns at various periods, and you've got to have conviction in what you're doing. You don't borrow conviction. You got to do the work. And if you're just punting on the back of something I've said somewhere, well, you're not going to have conviction. But if you've been through the work, you've been through the numbers, checked it all out, understand the valuation, understand the catalyst, understand when Macquarie Bank's going to want to do something and why they're going to want to do it then, and who's going to execute the transaction and who's likely to buy it and why they're going to pay up for it, and you know all that stuff, you don't worry about a 15% drawdown in your stock. You're not worried about what the share price is doing because you're not selling, because you know. You're not guessing, you now know. So I think that's when we say do the work. It's more about do the work to build the conviction to be able to ride the noise and be able to ride price volatility and understand that what everyone else is worried about, they shouldn't be worried about, and vice versa sometimes as well.
And then Luke, finally, your network matters is your last or the fourth lesson for 12 months.
Probably another unconventional wisdom. If you don't have access, if your thoughts are that a good pre-IPO or IPO stock or placement stock and block trades and stuff, which are an important part of running a fund, you need access to that stuff. And if not just for knowledge, even if you're not going to participate, you got to understand how the market's pricing stuff and where stock's moving and that. So that aside, if you do want to participate, you need good sources of that. And people often think that, I need a tier 1 sponsor. I need a Goldman Sachs to be on the IPO. I want Morgan Stanley to be on the IPO. Well, our view is actually the opposite of that. We think the best deals, the best opportunities to invest, the most mispriced assets don't come out of the place with 14 analysts and 16 bankers crawling all over it, pricing it properly, working for the client who's selling it to you. But in fact, come from no-name, one-man corporate advisors in West Perth or in, Darlinghurst or whatever. It's not, you need to have a network of people out there who, are bringing these deals to you. And then sometimes you need to be able to originate them directly from the entrepreneurs themselves. So XYZ guy wants to go and peg ground here and there and you want to back him to do that or whatever the case may be. Without that, that source of deal flow, and what I would call like a pure source of deal flow, not this sort of tarted up source of deal flow that you get from an investment bank or from a private equity firm. You don't get the opportunities to invest in really good businesses at insane prices. So like I'm 38 now. A lot of my mates are doing stuff. They're corporate advisors, they're mining guys, they're whatever, whether it's people I went to university with, people I've met through my career at different stages, or even just being in this industry for a while and, you know, working on desks and meeting brokers and talking to people and blah, 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 you know. We see stuff. And I mean, this year we were on 2 deals, both from a one-man corporate advisor out of Perth, who's one of my good mates' brother-in-law, you know, and I've known the CEO because he's my good mate's best mate from school. And he was a lithium guy and started a lithium company and James Bay Minerals and, you know, good guys, tight free float. We took a good position, made some money. Then did a silver thing, Sun Silver, SS1, Cornerstone that, 20 cents, like hit $1 the other day. Like lots, I mean, and they're both still cheap. I still think they're good investments. Like really good guys, really understand how stuff works and can spend a lot of time with them, can really understand where they're at, they're aligned, they're escrowed. Like, it's just doing it all properly, know it's done properly, you know, no rubbish options, you know, share weird stuff that you got to watch out for that comes to bite you later. And yeah, you can make a lot of money out of those kind of deals. And they've really contributed to fund returns this year.
Nice.
Well, Luke, in the first half of this interview, you've burnt big fund managers with lots of analysts and big investment banks. So I think we're going to be titling this episode, Luke Laretive burns his relationships with the top end of town.
I'm not burning anybody. The top end of town is never going to hire me or work with me, so it doesn't matter anyway.
All right, Luke, we're going to take a quick break here. And then on the other side, we want to turn to some of your takeaways from your recent Western Australia trip and then also some stocks you're looking at. But before then, just a reminder, if you want more of Luke, there's 2 ways you can get more. First of all, if you want to speak to him directly, if you're interested in his funds, head to equitymates.com/advice and we will put you in touch. Or if you're interested in Seneca's research, Luke and the team there, go to goodresearch.com.au and you can sign up to get 2 stock-specific research papers each month. And if you use the code MATES, you'll get 10% off your subscription. Welcome back to Equity Mates. We're talking to Luke Laretive, the founder and portfolio manager at Seneca Financial Solutions. Luke, we've just covered off the 4 lessons that you learned from the last 12 months of running your small caps fund. But now we want to talk about what you're learning today and where you're seeing opportunities today.
You want a stock tip, don't you?
Yes.
Well, I feel like you've given us a few so far, so we're not going to be greedy, but I reckon you're going to give us some anyway. So you recently came back from Perth or WA and looked at a bunch of mining companies. You are originally from Perth. You've got mining in your blood. So what did you learn? I guess what were some of the key takeaways generally, and then maybe some of the stocks that you got excited about?
Yeah, so shout out to Pilbara Minerals who kind of organised that trip for us, and we went over with a bunch of other analysts and investors and did kind of a day with Pilbara, and then we stayed overnight and had dinner with Wildcat Resources, who were 47 k's down the road, and had a night with them, and then did sort of a day with them, including a trip up to Port Hedland and did the port tour, Utah Port, which is like where all the non-major BHP, Rio, Fortescue, everyone else, Atlas and those guys all export their iron ore out of. So that was the trip. So thanks to those guys for hosting us, and we had a really nice time. And I suppose the takeaways from me, once you go up there and you see kilometre-long BHP Rio trains, ports, sand walls, dust walls that are up there just to protect Port Hedland from dust, port infrastructure that goes like so big. Like, I mean, you go to a coal terminal, you think they're big. Like, go to an iron ore terminal. Like, it's a completely another. Like, the scales are insane. The amount of material they're moving is insane, and that lead they've got, the competitive advantage they've got in iron ore is just unassailable. Like, it is a moat you cannot buy.
The majors.
Yeah. It's a moat you cannot buy in iron ore. You know, the iron ore price will oscillate, but those guys will always be there and be making really good money for a long time to come. Second, probably takeaway was just need to get out to find out. You know, like, I mean, I've done that sort of stuff before, but like taking Ben, he's only a young guy, 26, first time he's really been out to site like that and spent some time with people in their workplace. You know, we've got more of that stuff sort of planned pretty much every 2 months now. It's just what we're going to do a lot more of. It's one big advantage we have as professional investors is being able to not spend an hour with a management team around a boardroom, but spend 10 hours with them or sit over dinner and have a few beers and shoot the shit. Like, that's valuable. You get to understand people's personalities. You get to understand how maybe they're going to make decisions, or, you know, how they would react in different environments. You just get a vibe for them. Probably, you know, no different to you guys have got a vibe for me from, you know, spending a bit more time together. So, and I think also from a practical perspective, lithium market's not getting any worse.
Okay.
It's getting better.
Okay.
So, you know, from my perspective, that's going to be interesting.
Because you think the supply-demand dynamics have changed, or?
Yeah, I mean, the supply-demand dynamics have changed a bit, but the marginal cost of even just the current level of demand doesn't really support current prices. So I think we're starting to see some green shoots already, and it'll take China to turn around a little bit. Yeah, I just feel that M&A activity is going to start ramping up. We've already seen it. You know, Rio took Arcadium, and it was funny, we were talking about this Rio Arcadium potential for that deal. This was a week prior to the deal happening on the bus, and I had like 3 other institutionalized analysts who were there literally like laugh at me talking about brines. And, you know, like I'm a big like believer in lithium brines and have been for a while, and Vulcan, and we've been Arcadium shareholders, and they literally laughed at me like, Rio's never going to buy that, you know, it's not why would they do that, like blah blah blah. And literally a week later, Rio gone, deal.
Have you sent them? I told you so.
I try not to be, as much as I pretend to be a complete dickhead, I try not to be one in practice. Try and be kind and gracious when I'm not performing for you two. So no, I didn't do that, but like, we don't need to point it out. They know, I mean, everybody knows, right? Like, and it's okay to be right. We're wrong about stuff too. So you shouldn't, you know, I'm not trying to say, oh, look at me. It's just interesting, I suppose.
So one of the other things that you mentioned with, when you sent through your breakdown of the trip to us was that, you were interested in royalty companies. So for those listening who don't know what they are, what are they? And then why are you interested in them?
So a mining royalty is essentially a percentage of the revenue from production of a particular mining asset or of a mineral lease. So, you know, I own patch of ground, I've got a lease over XYZ patch of ground, and as part of the funding or the deal that when me acquiring that lease, maybe the guy who had it before says, yeah, you can have it for X dollars, but I want 2.5% of any revenue that comes from mining in that area. These royalties are like a free call option on production. So you can buy a royalty. What happens is that maybe that particular mining lease does go into production at some stage. And the big risk of being a mining investor and getting exposed to that production is the sort of equity dilution that can go along on the way. But as a royalty holder, you don't have any risk of equity dilution. You're only seeing the upside. So it's like super equity. There's also no cost. You don't spend any CapEx. You don't have to employ anybody. There's no OpEx. It's like a Goldilocks business model. And I mean, there is a version of this on the ASX, Deterra royalties, right? Like, so that's the big one that has, you know, mining area C royalties. But there are other companies that have royalties. You know, one of our portfolio positions, Red Hill Minerals, has a big royalty. There's a few others. I'm not going to probably maybe call out to every Equity Mates community member at the moment, but we've spent a lot of time looking at royalties, and, you know, we're now trying to originate royalty opportunities. So go to companies and say, hey, do you need funding? We can fund you. We think you've got a decent asset. But rather than give you equity in your business, what we want to do is give you a percentage. We're going to take a percentage for any future production.
How does that work in your fund structure? Like,
it wouldn't work in the fund structure.
Okay.
That would not go in a small company's fund. That would not go in a large company's fund.
So how does that work for you?
It would go in a Luke's back pocket fund.
Is that like a Seneca balance sheet investment?
I would say that would be a Seneca balance sheet investment at this point.
Okay.
We might look to do a royalties structure of some description at some point in the future.
As a separate fund. Yeah.
As a separate product. That would not be a marketed product, for lack of a better word. That might be a product that, it might be a product that there's 5 people invested in it. You know what I mean? Like, it's not something for everybody, because a lot of the deals we're looking at are, you know, on a 10 to 20 year horizon.
Okay.
So you put the money in and you might never see it again. It's only, you know, it's
like Bryce's portfolio.
Like, you don't see that for a different reason. That's a different issue. That's a slightly different issue. So, you know, this sort of investing is probably not for the average person, and I'd probably start spending 10 or 15 years just doing vanilla small cap equities in mining and get an understanding of that before you start having to go through proper legal due diligence on a royalty contract. You know, it's a bit of a specialist niche thing. There are a couple of funds out there. Regal have got a fund that do royalties. There are a couple of big international people who have funds that do royalties. They're generally only open to wholesale investors, and they generally do have lockup periods attached to them because of the nature of the investing that you do. It is probably like what most people would consider like an alternative asset class. It's just something that the way we're thinking of doing it, or the way we're looking at doing it, is different, I suppose, to what other people are doing at the moment.
So just before all that big disclaimer there, what were the names of the royalty companies listed on the ASX that you thought were interesting?
Well, I mean, I don't own Deterra Royalties, but that's the big one, the big large cap one, DRR. And then there's a smaller one, very limited free float. You can go look in. They've got some other assets, but the main asset we think they've got is this royalty. It's Red Hill Minerals. The code for that is RHI.
Nice. So look, I think we've done enough mining. Let's just open it up generally. What's taking your interest? Maybe from a thematic or like a sector point of view first, or like are there any companies that are taking your interest outside of the mining stuff we've just spoken about?
Someone asked me yesterday, like, what are my 3 high conviction ideas?
Yep.
There you go. Let's just use that as the question.
Done.
Okay. Well, you'll like this dumbass answer, but I've got 36 high conviction ideas.
No,
No.
but your biggest holding isn't the same level of conviction as your 36th holding. It can't be.
Pretty much.
I don't believe that.
The thing that makes something be, upweight something or downweight something in the portfolio might just be the duration, like when we think the catalyst is going to happen, when we think the value is going to get realised. We've got time. We've probably got time on stock XYZ, but we don't have time on stock ABC. Look, I'll just talk about the big positions in the portfolios at the moment. It's easy. So in the small cap, PointsBet, written about that a lot, talked about that a lot. Inflecting profitability, mispriced because everybody thinks it's a cash burning foray into the US when that business has been sold, capital's been returned. If you pull up a share price chart, it looks like it's business going backwards, but it's not adjusted for the capital return. So you'll miss it.
Have you doubled your money since you wrote about that?
You said it, not me.
I'm just looking at the chart now. I'm pretty sure. Yeah. Anyway.
Yeah.
You got
So
good research. You sent one through, and it was.
If you want to access these sort of ideas, like a lot of these companies I'm going to talk about, ironically, and the boys subscribers to goodresearch.com.au, which is our subscription research product, because like not everyone's a wholesale investor, not everyone's going to be able to invest in our small cap fund, but for $150 a month, we give you 2 really good, well-researched investment ideas. We've covered Wildcat, we've covered PointsBet, we've covered Catapult, we've covered lots of things that are ripping and got really good returns. So I encourage people to go and subscribe to that. We're going to cap that at 200 subscribers, so get in before it's finished.
If you do want to sign up, if you use the code MATES, you get 10% off the annual or monthly subscription across the board.
Very generous of me. Very, very generous of me.
No. So check it out.
PointsBet, yep. Catapult, another one.
Yeah.
Inflecting profitability. Market kind of historically hated it because they've been burning cash. They're no longer burning cash. They're in a growing addressable market and they're cheap. So we like that.
How do you think about so they're up 200% in the past 12 months? Like you still think they're cheap?
Yep.
Nice.
Wow.
So
Noted.
I made a half joke yesterday. I said to Ben, what EV to sales multiple is Catapult on? And he said, it's getting close to 5 times. And I said, I don't want to hear about it until it's on 10. Come back to me. We can talk about selling it when it's on 10.
Okay.
So, I still think it can double from here. And that's assuming there's no growth in the sales or the earnings, right? So
we actually interviewed Will Lopez, the CEO recently. How
was it?
It was
Convincing.
great. Yeah, he's
good.
And the thing that just so I am a Catapult shareholder. I've been for a little while. And the thing that gets me about it is these athletes get paid. Patrick Mahomes is on like $160 million contract. And to get a full team, the Catapult tracking gear, it's a $20,000 a year contract.
Correct.
It's just peanuts in the scope of what these
I got sent yesterday, day before yesterday, I got sent a private equity investment opportunity to invest in a US sports private equity fund. So they've got NFL, NBA teams that they own percentage ownerships of. And there is just more money, private equity money, going into sports as an alternative asset class because the returns have been insane for the other people who have been there. And as a result, I think you're just going to see the professionalization and monetization of these businesses. And a key part of that is managing the assets of that business, which are in fact the players. Yeah. So, and with more players, women's sport, collegiate sport, all this funnels down. All of a sudden you're going to have high school athletes wanting GPS data. You're going to have, it's just a massive kind of like flywheel effect at a scale that's kind of hard to fathom. We bought Catapult on like 3 times EV to sales. There's shittier businesses out there trading on 10, 15, 20. We think that's a ripper and we'll probably own that for a while. Wildcat we've talked about. It's a pretty big position for us. We just bought Megaport for the first time.
Oh, interesting.
Yeah.
It's in the large cap and the small cap at the moment.
How does that work? What's your small cap cutoff?
No, I think we don't have a small cap cutoff.
Oh, okay. What's your large cap cutoff minimum?
It's ASX 200 index included at the moment. Okay. But the large cap's about to change. So it's about to become ASX 300 because now we've got more coverage, Ben. Yeah. So we can cover more stocks. So why don't we? It'll give us better overlap between the two products as well. So yeah, Megaport's probably in that like mid cap area where again, everyone hates it. It's missed consensus growth numbers by like 15% at the last report. It's burnt cash for a long time, but ironically, and the share price is down like 50%. Ironically, they're more profitable than ever.
Wow.
Like again, it's just like the narrative around a business, and I mean that business was on 25 times not that long ago. I just bought it on less than 5. You can just buy things on a narrative, and you can just buy and hold. And Megaport's a great example of a business where if you just bought and hold that because of the narrative, you would have lost a lot of money. And if you have no valuation discipline, if you've got no concept of what something's worth relative to other things, next best alternatives, blah, 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 well, you're going to end up riding an insane maybe wave, even if you are right, in the macro, and you're going to leave a lot of money on the table as a result. So I think this is like the perfect example of that. It's all narrative. Luke's never owned it. Everyone's been wet about it. And then all of a sudden it's falling out of bed and you're actually, for the first time, it's actually making money. It's really interesting. Even there's this, in like mining stocks, there's this Lassonde curve, you have this hype cycle, then it all falls out of bed during construction, and then on production, it ramps back up again. And it's kind of like that. Like it's sort of in that sort of wheelhouse, Megaport. And I think now's a really good time to have a look at it. It's cheap.
Nice. Well, Luke, we'll leave it there. Left us with some stocks to think about. If you want more of Luke's insights or Ben's insights, depending who's writing them, but
if they're good, it'll be Ben and me taking credit for it. If they're bad, I'll say it's Ben's idea.
You can head to goodresearch.com.au. As Luke said, there's some subscription options there to get 2 research papers each month with stocks that are either in the portfolio.
How are you finding them, Bryce? You've been reading them.
Yeah, well, I mean, stocks that we've spoken about today, you've included and sent them all through. I think there are some. It's a great resource to get some good information and new
enjoying
ideas.
The research.
Yeah,
enjoying.
Yeah.
Alec, you reading?
A shame I haven't I haven't actually deployed. But anyway,
can't borrow conviction.
That's it. Use the code.
That's not a good sell for the research product.
Use code MATES for 10% off. Otherwise, head to equitymates.com/advice. We'll connect you with Luke if you're interested in either of his funds as well. But Luke, as always, absolute pleasure.
My pleasure, gentlemen. Always love being here.
Well, you'll be back next year with some Pimp My Portfolios, but probably more of this type of stuff, I think. So
whatever you want, you can have me whatever way you like, Bryce.
Nice. Love it. Thanks, Luke.
Thanks, Luke.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.